I'd like to start this presentation with a special thanks to all of you who have expressed concern about my whereabouts. It's been many months since my last video. My job has been quite difficult lately, and I'm sure it's aged me quite a bit. I'm hoping this will change soon. In the meantime, please know that I'm still here watching as events unfold, and I have not changed my mind about what makes for a firm financial foundation for building wealth. I'll answer questions that come in as I have time, and maybe from time to time have a chance to make a new video. So with that said, let me get into the subject of this video. I've said on numerous occasions that I would not criticize a person for having a 100% gold holding, provided they knew what they were doing. What I mean by that comment is that a person should have enough knowledge to justify having a firm conviction that the market price of gold does not reflect its true value. My research is indicating that it is currently the case for gold. It also means that the person has to be mentally prepared for prolonged periods of time when the price of gold declines significantly. For example, although the price has declined significantly since the year 2011, I believe the value of gold is well above $1,900, and the multi-year correction was just that, a correction. I hold the same opinion about a person who chooses to hold stocks, by the way. If a person has enough knowledge about the stock market and is prepared to ride out substantial losses, then that person will probably do just fine holding a portfolio consisting of nothing but equity ownership in large ongoing enterprises. But what about the person who doesn't have time to spend years reading through countless tomes of economic theory to draw strong conclusions in the face of what oftentimes appears to be contradictory information? Should that person invest in one singular asset at the exclusion of all others? Will that person have the fortitude to hold on when the initial outcome of the investment decision looks dire? Or will that person sell out of fear of the worst possible time and lock in punishing losses? This video is dedicated to that person who would like to build wealth but not have to worry so much about the uncertainty of the long-term outcome. I'm going to present some historical data starting from August 1971, which was when Richard Nixon severed the ties between the dollar and gold, and I will try to do it in such a way as to let every viewer draw their own conclusions as to what course of action makes the most sense for their particular situation. Let's start with a chart showing real inflation-adjusted yearly returns for the S&P 500 stock index shown in red, and gold shown in blue. The returns shown include stock dividends. They also assume that there are no costs. So I'm omitting here mutual fund fees. I'm omitting coin broker premiums on gold purchases. I'm omitting taxes. These are real considerations, but since they will complicate the discussion, I am leaving these factors out. Notice that the range of outcomes for gold and stocks held for only 1 year are quite variable. Also note that both assets appear to be equally uncertain on a 1-year basis. There have been times when a person could see his or her purchasing power drop by 30 to 40% in a single year by holding gold. There have also been times when a person could see his or her purchasing power drop by the same amount by holding stocks. I believe it is possible to avoid large losses by being an educated investor. But even still, a person needs to be prepared for such large decreases in purchasing power. For the novice, it's probably a good idea to only hold gold or stock for long-term savings goals of 5 years or more. Let's take a look at another way of representing the data. On this graph, I've summarized each of the yearly returns for stocks and for gold on the left and right sides. On the far left, shown as red dots, are the yearly inflation-adjusted returns of the S&P 500. I show as a yellow diamond the median yearly return, and as a gray square, the largest yearly inflation-adjusted loss. Notice that although the median rate of return has been 9%, which is a pretty nice return, the worst yearly loss was 40.6%. This is a pretty tough outcome for most people to ride through, and is why many financial professionals recommend a portion of assets be held in bonds. Now, I've shown in previous videos why gold is a better portfolio diversifier than bonds for long-term holdings, so I won't go into that now. All I will say is that a person is probably better off holding a cash equivalent for short-term savings needs. On the right-hand side, in blue, I show all of the outcomes for gold held for 1 year. The median rate of increase in gold's purchasing power is 0.9%, and at the same time, the worst yearly loss in purchasing power is 42.6%. This is quite a punishing performance for someone who just wants to save for a rainy day. But there is no reason why we shouldn't ask ourselves if a person who holds both gold and stocks shouldn't do better than a person who holds only one at the exclusion of the other. For this reason, I include on this chart all of the yearly outcomes for various mixes of stock and gold. These are shown in 10% increments in gold percentage, with the leftmost side of the chart representing pure stock and the rightmost side representing pure gold. One can see that as gold is added, the magnitude of the worst loss declines. In fact, the least volatile yearly holding is 40% gold and 60% stock, which has a worst-case yearly loss of 25.8%. This is still a large loss, and the reason why I hesitate to recommend that a person should neglect cash equivalents for short-term savings needs. The median return for the 40% gold portfolio is about 2.5% lower than for the 100% stock portfolio. But I'd argue that on a 1-year timescale, median returns are not very meaningful. After all, if I told you that the median return of an investment is 6.5%, but I couldn't say with any certainty that the actual outcome wouldn't be worse than a 25.8% loss or better than a 68% gain, then why should you care about the median return? I'm going to move on to a longer time horizon now. So I'll suggest that if you'd like to study this chart in more detail, you hit pause on the video now. Just let it stick in your head that if you have a purchase to make in a year or so, then you really should stick with a cash equivalent for that purchase. Gold and stocks are just too volatile and should be considered long-term holdings. What a difference a few years can make. Notice that the range of annual outcomes has changed considerably by changing the time scale to 5 years. Now the annualized worst-case loss in stocks is 8.4% per year, and the annualized worst-case loss for gold is only 19.9% per year. I'll tell you right now, though, that this information is somewhat misleading, and pause to let you think about why this might be so. The reason why this information is misleading is that I'm presenting it in the same way that Jeremy Siegel represented his data in his famous book, Stocks for the Long Run. Siegel presented his ranges in terms of annual return, but over a long enough time period, annualized return gets amplified. Let me show you what happens. Take special note that the extremes for stocks and for gold is an 8.4% loss and a 19.9% annual loss, respectively. When the data is re-expressed in terms of total return, an annualized loss of 8.4% per year turns into a total loss of 35.4%, and an annualized loss of 19.9% per year turns into a total loss of 66.9%. These are some pretty large total losses. And so one can conclude that an extra few years does not necessarily help someone who owns only one asset class or the other. One has to be very careful when presented with annualized percentage numbers. What might look like a small risk can actually be very meaningful over a long time period. But cast your attention to the middle of this graph for a minute. One can see that the magnitude of the worst loss decreases as one approaches 40 to 50% gold. With a 30% gold, 70% stock holding, the worst total loss is 17.4%. With a 40% gold holding and a 60% stock holding, the worst total loss is 15.8%. And for the 50-50 mix, the worst total loss is 14.1%. Now we're getting into the range that many people would feel is acceptable. It's not fun to lose 14 to 17% purchasing power, but at the same time, it's not the stuff that Shakespearean tragedies are made of. In this range, the median total return is in the 30 to 35% range, which is not too bad to be sure. Now take a look at the 100% stock portfolio. It had a median total return of 41.7%. This is 10 to 15% better than the portfolios that had a mix of stock and gold. But that additional return came at a risk of a worst loss that is double what is seen for the blended portfolio. Sure, stocks had some years with tremendous gains, but so did gold. Nothing is guaranteed. I personally think avoiding a tragic loss is more important than having an opportunity at a large gain. After all, a prudent savings plan over the span of years can lead to significant wealth, even in the face of modest returns. However, it's really difficult to overcome the consequences of a large loss in wealth, especially towards the end of one's career. So now let's turn our attention to a 10-year time horizon and see what happens. I'm not going to bother showing annualized returns because, as we've already discussed, they can be quite deceptive. I'm just going to focus on total returns. Those are what matter. Notice that for a 10-year holding period, the worst loss for stocks was 40.7%. Hey, I thought the risk of stocks was supposed to go down the longer you hold them. That's what Jeremy Siegel said. But we see that the worst total loss in stocks over a 10-year time frame was actually 5% worse than the worst return for stocks over a 5-year holding period. Don't get me wrong, gold has its issues too. The worst total real loss for gold was almost 65%. This is a really bad showing. It could have been avoided by not buying gold in 1980, but not everyone has the knowledge to know when to avoid such times. The pure stock holding is the benchmark used by most financial pundits. Let's compare the pure stock holding to one that is blended with gold. The median total 10-year real return for stocks was 92.4%, and the worst 10-year loss in purchasing power was 40.7%. As gold is added to the portfolio, the median return declines, but not nearly as quickly as the risk of loss declines. In fact, once 30% gold is added to the portfolio, there was not a single 10-year period with a loss in real purchasing power. For this portfolio, the worst showing was a 9.8% increase in total purchasing power over the 10-year period, and the median return was a real gain of 81%, a near doubling in purchasing power. This 81% median return is about 10 points shy of the median return from 100% stocks, but it came with significantly less risk. For the aggressive saver, this is really quite powerful, and I'd suggest you let it sink in. Think of it this way. The worst showing for the 30% 70% portfolio was a 9.8% increase in purchasing power, which works out to be about 1% per year. The current real interest rate on a 10-year TIPS bond, considered by many to be the least risky savings vehicle, is only 0.25% right now. And the 30% gold, 70% stock portfolio has a substantial potential upside with as much as a 200% increase in purchasing power over 10 years, which when re-expressed is a tripling in wealth. Now, I'm not advocating a particular position for anybody, just offering some observations for those who hear the conflicting advice of so-called financial experts and are confused as to what to do with their savings. The main things that I think should be considered by many are the following. First, large losses in purchasing power are very punishing. They are hard to make up for, and so they really should be avoided. Many people lack the skill to avoid large losses because good investing requires lots of study, and even the professionals don't get it right consistently. Next, holding stocks for a period of 10 years or more does not guarantee a successful outcome, even though the widely held popular belief is that for a horizon of 10 years or more, a person should be almost 100% in stocks. Next, on a short-term time horizon of close to 1 year, neither gold nor stocks nor a mix of the two is really a good savings vehicle. For short-term expenses, cash or cash equivalents is probably the best way to guarantee that obligations can be met, and I've covered this in other videos. Next, for long-term expenses, the right combination of gold and stocks can offer some degree of assurance that purchasing power can be maintained or modestly increased with a potential for significant upside growth. Finally, the percentage of gold that minimizes risk appears to be higher than the 5 to 10% that most financial experts propose, at least according to the historical record. So that's it for this video. I hope you enjoyed it. I enjoyed having some time to make it. Hopefully I'll find some more time to make more frequent videos. In the meantime, please feel free to reach out. I'm here watching the events unfold alongside you.